name is Piper Steggy-Nelson, and I am the publisher of the Texas Observer. As many of you know, started in 1954. We have been telling the untold stories of Texas from the strangest state in the Union for nearly 60 years. And one of the things that we've been doing is trying to conduct more events like this where we can have a conversation about the issues that are taking place in real life and being reported on our website and our pages. Tonight we welcome you to an event on payday lending and the auto title loan industry. I actually don't know as much as I should about this, so I'm really excited to learn more. I want to let you know that we have subscription cards out there. If you are not a subscriber, we would love to have you join our community. And we would also love for you to join our mailing list so that we can tell you when we're having more discussion forums like this. And with that, I'd like to turn it over to Forrest Wilder, a reporter with the Texas Observer, who will take charge of the panel. Thanks, y'all.
Thanks, Piper. I'm Forrest. I'm a staff writer with the Texas Observer. Thank you all for coming out tonight. The topic, if you didn't already know, is reforming the Texas payday and auto title lending industry. And very pleased to have 5 distinguished panelists with us tonight. Before I introduce them, I'll just kind of go over the format. They're each going to speak for 5 minutes or so, and when I say or so, if you go much over, Piper's going to cut you off. We want to do strict enforcement on this. And just offering your thoughts on the topic, giving us the kind of lay of the land. Then after that, we'll have a moderated discussion, and then we'll go to questions from the audience. Should be done by 8:30 at the latest. So I guess I want to start, because I don't know if everybody's familiar with this topic or how familiar you are with it. I know some of y'all, this is what you do, so I'm not telling you anything you don't already know. But just some head-turning statistics about payday lending in Texas. So the number of storefronts in Texas in 2004, there was 1,300. And now today there are 3,400, so something like close to a tripling of stores reflecting the growth in the industry. Unlike many states that apply usury laws and regulations across the board for short-term lending, Texas, there is no limit to the fees that can be charged. And so as a result, APRs are frequently above 500%, something like that. So what often happens is that consumers find that they can't pay off the loan when it comes due, and so they'll roll over or refinance the loan and get stuck with a new set of fees as well as whatever the unpaid balance is, and get into a cycle of debt, which is really kind of a focus of the legislation that's at the Capitol, and I think a focus of a lot of the folks up here. So 4 out of 10 Texas payday borrowers end up rolling over 5 or more times. And then auto title lenders in 2012, there were over 35,000 cars that were repossessed by auto title lenders. It's the title of the car that secures the loan. If you can or won't pay it off, then they can repo your car. Last year, Texans paid a collective $1.25 billion in fees to lenders in Texas. And by some estimates, Texas provides this industry with about 60% of its profits nationwide. So regardless of your view on what should be done, this question of what should be done, if anything, I guess the industry might say nothing. This is an industry that's grown explosively, and it's had a big impact on individuals, families, communities, churches, charities, and shows no signs of slowing down. So last thing, I think the timing of this panel probably couldn't be better. For those of y'all who follow this closely, today was a pretty dramatic day at the Capitol. The big kind of payday reform bill came up for a vote in the Senate. The author, Senator John Corona, explained that he reached some agreement with the different parties. That he mentioned he had 28 votes out of 31 in the Senate, and it seemed like this thing was going to kind of move, and then something happened. And next thing you know, he's suggesting that some of his colleagues, or shills, I think that was the word he used for the payday loan industry, said that lobbyists were calling senators on the floor trying to change votes. It became a pretty heated, ugly, maybe even debate, and we'll maybe have a chance to analyze that a little bit. So that's my spiel. Thanks for indulging me. Let me introduce our panelists, and y'all had very long and impressive bios, but I'm gonna shorten them dramatically, even shorter than what I have here. That's okay. So to my left, I got Ann Baddour. She's a senior policy analyst at Texas Appleseed and the director of Texas Appleseed's program to promote access to fairly priced financial services for low and moderate income communities. And I think it's safe to say one of the real experts and advocates on this issue. So maybe I'll introduce y'all as you come up. So let you take it away.
Great. Well, thanks, and it's really exciting to be here. Lots of familiar faces in the audience, but also, you know, great to see a lot of people that we haven't seen before. And I was going to start by giving some background. You know, a lot of people, we did some polling on payday lending in the summer, and it was very interesting, the responses. Overwhelmingly, people have a negative response to payday lending. When we ask people to provide words, like what words do you associate with payday lending? Scam, high cost, loan shark, exorbitant pricing, desperate, were some of the words that came to mind. And these are just, you know, a sampling of our voters. But a lot of people, I think, who have never walked into a payday loan store are shocked when they learn about the details, and some of the details that Forrest shared. I mean, we see these stores within a 2-mile radius of my house. I think there are 10. There are 2 Title Maxes, there's 2 Easy Cores, an Ace Cash Express, a Cash America. I can go down the list. And so they're all over the place, but unless somebody's walked into one of these stores, you know, people don't always know that the kind of loans that they're offering are at 500, 600% annual interest rates, and the kinds of problems that getting caught up in a loan like that can cause for a family. But I think that a basic question that comes to mind, and I would have asked this question if I didn't already know a lot about this market, is how is that legal? How do we allow people to charge 600% interest? I thought that we had usury laws and caps, and the answer is, well, there are usury laws and there are caps, and I wanted to take us a little back in time, and I promise I won't dwell on it too much or take too long, but you know, payday lending is a relatively new thing, and I guess maybe by saying relatively new, it gives my age away, because I think of the 1990s as not that long ago. But I guess for some people they are. But you know, if you go back, you know, two decades and a little more, that's kind of when payday lending first came onto the scene. It has its birthplace in Tennessee. From a lot of the literature, that's sort of where people tie it back to. And in Texas, when this kind of lending started to proliferate, there was a lot of outcry against it. And I wanted to read to you a quote that struck me as I was looking into the history. Then our then Attorney General, who was now our our national federal senator, John Cornyn, had engaged in some litigation against some of these businesses. And what he said is, this kind of abusive payday lending is illegal in Texas, and those companies who continue this practice will face serious consequences. And so that was the state of the law in the late 1990s, and that litigation was followed up with some movement in the legislature. In 2001, payday lenders were officially placed under what we call Chapter 342 of the Texas Finance Code, which is where the rate caps governing consumer lending and state law lie. And after that session, people thought, okay, we've done what we need to do, we've addressed this issue. Well, what ended up happening is, after the 2001 session, there was a movement toward a series of loopholes to get around the usury laws. First, payday lenders partnered with out-of-state banks in a model called the rent-a-bank model in a lot of the consumer literature, with banks, small banks generally in states that didn't have usury caps, and then importing those rates into Texas. In 2005, the FDIC, through some rules, they passed some rules saying that banks that were engaging this kind of lending collectively could not keep an individual in debt more than 3 months across any bank. So it's effectively a 2-week payday loan limit over a 1-year period. And so as a result, in Texas, they found a new way to do business. And that's sort of what gets us to where we are now. There was a Fifth Circuit Court decision in 2004 called Levick v. Right Money, where they ruled that this part of the Texas law called the Credit Services Organization Act that just a few players, and actually an elected member of the Texas House of Representatives was one of those players, who had found this way to do business to get around usury caps. It was challenged in the federal courts, and the federal courts ruled that in the Fifth Circuit that because there's nothing in the law that explicitly states that the fees charged by these businesses are subject to the usury laws, that therefore they're not. And so that kind of became the state of the law from 2005 moving forward. And as Forrest mentioned, in 2004 there were 1,300 of these stores, and now there are 3,500. I mean, the number keeps growing. And so the challenge has been, how do we start rolling that back? And so I think that dynamic really defines where we are. It defines the push last session that took place to try to start to put some boundaries around the operations of these businesses, and really defines the push that we're seeing right now to try to pull these lenders under a reasonable regulatory scheme. And I think the question that we have is, you know, I'm concerned we don't want to fall into the trap where they've found a loophole, they've been able to exploit the loophole, and now we totally legitimize everything that they're doing within the loophole as the legal solution moving forward. And so that is sort of my framing and one of the key issues that's guided my analysis of this. And so I guess we'll pass it on.
That's great. Next we have Councilmember Bill Spelman. He's serving his third term on the Austin City Council, and I guess you probably feel at home here at the LBJ School. You are a professor here. You teach courses in applied math and statistics, urban policy, public management, and important to this discussion, he led the successful effort to pass 2 City of Austin ordinances that address payday lending.
I feel especially comfortable in this building, in this room, because I teach classes all summer long for entering LBJ students. I feel particularly comfortable because Piper and Bee and Ann are all former students. Alumni Association meeting after. I feel a little uncomfortable because everybody on this panel knows more about payday lending than I do. On the other hand, there's a value for what it is I'm doing here, partly to be the clueless guy who keeps asking, well, so what happened next, Ann? And she'll tell me. And partly because cities are in a very peculiar position with respect to regulation of payday loans in this particular time, even on this particular day. Last session, some of you already know this better than I do, but let me recap it for those of you who haven't gone through the play-by-play yet. Last session, there was a bipartisan effort to try and regulate, for the first time at least since 2005, the payday lending industry. Had bipartisan support, led in part by Ken Chaddick, who was not the first guy you would think of as being in favor of regulating an unregulated industry. But he had a personal story, as a lot of people involved in this do. I can't remember who it was a story of, but somebody who knew who had gotten involved in one of these cycles of debt and not been able to get out of it. And he really felt very strongly at a very emotional level this is something that needed to be done. This is very much like the background check legislation that just failed in the Senate yesterday. Was it yesterday? Yeah. So soon as yesterday that failed? Yeah. Same kind of deal. You had some people got together, and we had bipartisan support for something which actually made a fair amount of sense, and then it just kind of got nickeled, and then the whole thing fell apart because in addition to bipartisan support, it also had bipartisan non-support. Same thing happened by the payday lending legislation last session. There was, I'm not sure whether it was a joke or whether it was real, but somebody told me there were 181 lobbyists working on behalf of the payday lending industry last session, which would be 1 lobbyist per member of the legislature. I can imagine somebody sort of walking up and says, "Hi, I'm Robert, I'll be your lobbyist for the remainder of the session. I'll follow you wherever you go and hand you money whenever I need to get you to do what you got to do." Anyway, it didn't pass. And at the time it did not pass. It was a fairly sensible, it would not have gone as far as I suspect Ann or B or other folks would have wanted to go, not as far as I would have wanted him to have gone, but it was a good start and it would have knocked what I've been saying, the rough edges off of the payday lending industry. But it didn't pass. So I knew very little about the subject until I got a phone call from a fellow named Jerry Allen. Jerry Allen is a banker who happens to be on the Dallas City Council. And like Ken Chaddick, he's a Republican, Jerry is. Has he told you that?
No.
He's a Republican. Some of my best friends are Republicans. Now that's true because of Jerry. So Jerry has a story, and in addition, he has this whole set of stories because as a banker, he's had to deal with the usury limits all his life, and he feels it's just a travesty to go over the usury limits. So he was going to do for the city of Dallas what it is that this bipartisan group was unable to do for the state of Texas, and crafted an ordinance which more or less modeled point by point what that lost statute that never got passed last session, and passed it in the Dallas City Council. Became law in the city of Dallas. Well, gosh, if Dallas could do it, sure as heck Austin could do it. I'm feeling a little embarrassed Dallas beat us to it. So the city of Austin passed a bill a year ago which mirrored the legislation. So now it's the law in the city of Austin. We've been having long conversations with Houston, with San Antonio, with El Paso, and other cities. And although Houston decided not to go that route, San Antonio did. And very recently, in the last 3 months, I think El Paso also passed more or less the same bill. So now you get 4 of the biggest cities in Texas which have done what the state of Texas was unable or unwilling to do. The big question for us during this session, well, the big question should have been, will the state of Texas do this session what they could have done last session? That was never on the table. What was on the table was a considerably weaker regulation. I don't believe at any time that the regulations offered by John Cronin and his committee were as strong as those offered by King Chaddick in the previous session, but they were a start. And the critical question is, can we keep them strong enough that it will make more sense for us to support these things statewide, or will they become so weak that it will make better sense for Dallas and Austin and the other cities to want to kill those bills because we've got so much stronger stuff that we can do locally? From the city of Austin's point of view, there's a real value to having a statewide legislation which is at least got some teeth in it. Because we got a lot of people in Austin who can just go across the city line and go to Pflugerville, they can go to Westlake Hills. There's a lot of places, a lot of people who live close enough to the city line that it's not going to be any trouble at all for them to find a payday lender who is not bound by the city of Austin regulations and get a 500 or 600% APR loan. We'd like to prevent that, and if there were a way we could do it, we could. I don't know exactly where we are right now at this moment. I'm not sure anybody is. But from my point of view, and from the point of view of Dallas, San Antonio, and El Paso, we had a long conversation about this last week. If the bill that eventually is available for us, available for passage, is not sufficiently strong, we feel that we're better off being against it and trying to kill it. Or if we can't do that, if we can persuade, for example, Representative Villarreal or Senator Corona to insert something that says that cities are not preempted from acting just because the state legislature has acted, that would allow cities like Dallas and Austin, which are in a financially different position than other cities around Texas, and I'll explain why later if the issue comes up, to be able to do for our constituents what our constituents need, which is a very different situation, very different from what constituents elsewhere in Texas need. I have more to say about that if you're interested, but this is a peculiar situation where a city council and 4 city councils around the state of Texas are actually involved in banking regulation. I don't know any place else in the country where that's true.
The next up, we've got B. Moorhead. B is the Executive Director of Texas Impact, a statewide religious grassroots network whose members include individuals, congregations, and governing bodies of the Christian, Jewish, and Muslim faiths. She's also the Executive Director of the Texas Interfaith Center for Public Policy. And I notice I have someone seated between you. I should say that there's between you two, that there's been a little bit of some disagreement in the community of advocates over some of the particulars of the legislation that we're addressing, and so I hope you can speak to that and to anything else you like in your allotted time.
All right. Well, I appreciate being invited to participate as well. I guess for the purposes of this panel, although I'm representing the faith community, we have a pastor who's also representing the faith community. So I think I'm going to try to set out as clearly as possible why Texas Impact supports the legislation that Councilmember Spelman. I thought you were saying you had put in between us because he's both of our teachers.
Oh no, I just didn't want you to get into a fight or anything.
That's fun.
Well, spoken like a true reporter. Trying to instigate a fight.
Right.
Very good.
You know, I think we have at least a particular perspective Texas Impact does. And part of that perspective is probably my own personal perspective, coming from the LBJ school and coming from kind of a numbers policy background. So my policy background is in state budget, and so when I look at a policy issue, a lot of times the first thing that I will think about is what the fiscal implications of the policy are. So that's been the way that we've approached this issue a lot, has been as a fiscal policy issue. I'll start by saying there's a difference between regulating and outlawing an industry, and I think that one of our big concerns has been the need to keep talking about regulating an industry that it is true already exists, rather than outlawing or severely constraining an industry that a lot of people think is gross. There are a lot of industries in Texas that are regulated and nobody likes them, or I mean, some people like them or they wouldn't make money, but we'd rather not talk about them. Payday lending is potentially one of those things, but it is an industry that exists. It exists because there's a demand for it. And while it's true that the payday industry, the way that it exists in Texas, is a relatively new thing, the basic need and the basic parameters for payday lending and things like it are very old. The idea that people lack access to money and they will go to someone who will let them have it at what will be a future high cost, that's not new news. That's an old practice. That's why we have usury laws in the first place. But it comes from a lot of larger issues, right? I mean, we have part of the reason that people go, in fact, I think a lot of the reason that people go to payday lenders is because of medical bills. Well, the legislature, oddly, is also debating legislation that would provide health insurance to a lot of people who currently go get payday loans to pay for medical expenses that people who have insurance would never worry about. So it's a little bit, I think from our perspective, not fair to look at just this one issue and say, well, this one thing is bad, so we need to come down hard on it, when it actually is in relationship to a lot of bad circumstances. And there is no denying that for a lot of people in Texas, payday lending seems like a rational strategy. So we thought that the best way to approach the issue was to look at the numbers and to see, would there be legislation that would actually, sort of setting aside what you think about the lenders and setting aside whether you think it's not fair that people can take advantage of other people or whatever, would there be a way to save borrowers money in payday lending? So could you have a legislation that would result in clear, measurable benefit to the people who appear to be injured currently? And the answer, I think, is yes. And we actually think the legislation that had an exciting day in the Senate would do that. So currently, you have to, I think about, of all the payday loans that are issued in the state right now, most of them are what are called classic payday loans. They're a single payment transaction where somebody goes in and gets money, and then 2 weeks later they're supposed to go back and pay it off. And about half the time, that is actually what happens. Person gets the money, they know what they're getting into, they go back in 2 weeks, they pay it off, and Bob's your uncle. The other half of the time, those people, there's something happens, there's a snag, and they have to go back and roll the loan over. And when that happens, they roll it over often a lot of times. The number that the regulatory body, that the OCC, the Office of Consumer Credit Commissioner, sort of caps out their reporting on is 10 loans, so that 10 times rolled over. But I talked to a woman last fall who had rolled her loan over. She was well into the second year of rolling her loan over. So this was someone who had gotten a $1,000 loan, and for 2 years she had been going in and paying a fee every 2 weeks to not have to pay that $1,000. The benefit to the legislation that's been offered is it cuts off that opportunity for endless rollovers. It is a huge benefit because most of the market is those loans. It prevents the worst excesses, it doesn't do everything for everyone. I mean, there are people who are gonna go in and they're gonna know that they're taking out a loan at a very high interest rate. They want that money and they're gonna go ahead and take it, and in a couple weeks they're gonna go back and pay it off, and they are maybe gonna go back and do that again after that. But for the people who got in over their heads and are now potentially gonna drown in this debt over a long period of time, the legislation that was introduced and had its excitement today would cut off the worst excesses and put us on a path to some sort of regulation, and that's why we support it.
Next we have Dr. Chaddick. He's been a pastor of Northeast Baptist Church in San Antonio, and thanks for driving up here tonight, for 4.5 years. Prior to that, he served in Baptist churches in the Panhandle of Texas and in South Georgia. He's a graduate of Wayland Baptist University, George W. Truett Theological Seminary, and Beeson Divinity School. He's also an occasional adjunct professor for the San Antonio campus of Wayland Baptist University. And he represents an important voice. Churches and faith organizations have been, I think, really critical to kind of advancing this debate. And toss the ball to you.
Absolutely. Yeah, and thanks for inviting me to be part of this. I'm glad to drive up and do this. I think I'm here because I have a story. I kind of sit on the front lines, as it were, not in that I'm taking payday loans, but that I'm dealing with those who have. That they're the ones who come into my office and sit down across from me. And usually the conversation begins with, I have a problem. I can't pay my rent, or I can't pay my car payment, or I can't pay my utilities. I've never had somebody who's come in and sat down and said, I have a problem with a payday loan. It's always, I have a problem with something else. And as we begin to work with them, and part of the policy of our church is that as church members come in and have financial problems, that we sit them down with somebody to work through family budget type things. And we're not in the business of helping them pay for their car or to pay for their house long term, but to lift them up out of a sticky situation. So we want to ensure that we can do that. So it's in the sitting down with them and working through the budget that we usually discover that they have a payday loan, that is pulling money out that could be used to pay for rent, could be used to pay for car, could be used to pay for whatever the problem happens to be. And in my particular case, the first time I really was introduced to the payday issue was almost 3 years ago. I had a family who come in, and their problem was that they were behind on their rent and weren't going to be able to make this month and were in danger of losing their house. And so immediately we kind of set to work to think about how we could remedy this problem and help them get through this. And so I had them sit down with one of our deacons to walk through a family budget planning time. And he called me later that night, and he said, Chad, it can't be done. And he'd never said that to me before, so that got my surprise. He said, they can't do it. And I said, well, what do you mean they can't do it? He said, well, the money just didn't work out. He says, they've gotten into this payday loan. He said, they're paying $200 every 2 weeks on this thing. I said, $200 every 2 weeks? You're telling me they're paying $400 a month on this thing? So how much is the loan? He says, well, it's a $700 loan. I said, well, how long have they been paying on this? And he said, well, he says, they paid $1,800 on it so far. I said, well, how much is the loan still? I mean, how much do they still have? How much do they owe? He said, well, they still owe $700. It's just, I mean, that's the rollover. It just resets it. And my initial thought was, as Ann mentioned, was that can't even be legal. That's so wrong on so many levels that just can't even be legal. So we set about to helping them kind of dig their way out of that hole. And you know, several things kind of really bothered me as I began to do that. Besides the initial impact of saying, you know, that can't even be legal, you know, I realized that if anybody had actually sat down with these folks and looked at any kind of income and expense for them, they would know that these folks would never have had $700 in the course of 2 weeks to pay the whole thing back. That this was set up for them to roll over. In fact, it was designed that way. It was designed as an automatic debit from their banking account, so that every 2 weeks, $200 was automatically removed, basically timed with his paycheck. So first $200 out of his paycheck was going to the loan. And I thought, you know, no one sat down with these folks and checked this. And so again, there was this real sense of injustice, really kind of a moral kind of dilemma here, that this is just simply wrong. And as I thought, you know, this can't even be legal, I began to make some phone calls to try to figure out exactly what needed to happen here. Who did I need to talk to bring this to somebody's attention, because obviously this was out of bounds. And it was only in making those phone calls that I realized that it wasn't out of bounds, that it was perfectly legal, and that this was going on all around the state of Texas. But it just so happened that about the time that I was making the phone calls and we were working all of this out, we were entering into last session with some of the chances for legislation there. And so I was invited to kind of be part of that process. It was a very learning experience for me as far as that goes. But in the last 2 years, I have told this story a lot, and I've since gathered more stories, both from mine personally and from talking with other pastors. And I found that the reaction is common across the board to the first time that you hear this story or others like it. It is simply that this is wrong or it's not legal. In fact, we heard testimony on Monday with the House Bill 2019, the DA from Midland, Texas, Chaddick's DA, dealing with this same story. Her initial reaction was exactly the same thing. I thought that was interesting that a DA who should know about all of this would immediately think when she heard this kind of story, well, that can't even be legal. And so I make this story, I tell this story, and I make this comment tonight because I know there is the money side of thing, the numbers side of thing, and Bea has shared about that. I don't tell the number side of it. For me, it's faces. There are faces across my desk who have these problems, that are dug into these troubles, that the churches, that the benevolent agencies are increasingly having to help out of difficulty that have been caused by the ready access to this kind of credit. They are being unsustainably propped up, as it were, and they are failing. Catholic Charities has been very big on this. In fact, Monday again at the hearing, we had representatives from Catholic Charities in Dallas and Austin and Houston. There was someone there from Galveston as well. And their testimony is that probably about 30% of the folks that come into in their doors are caught up in one of these payday loans, and that's exacerbating the problem. And again, there's something that strikes me as being unfair about that. That charitable dollars are going in, and in some ways I am subsidizing the payday loan industry, even though my money, the check may be going to the utility company, or it may be going to the rental agency. The fact is that it wouldn't have to go to the utility company, or it wouldn't have to go to the rental agency if they weren't paying $200 every 2 weeks on a loan. So there's an unfairness about that as well. There's been several little unfair kinds of things that have come back that it just strikes you as simply being wrong. There's the military aspect of this. Some years ago, and Ann can probably tell you the dates and the history a lot better than I can on this, the Department of Defense declared these kinds of loan products to be a threat to national security because they hinder the readiness and the ability to deploy our military personnel. The Army is not going to deploy someone who is in debt and leave their family behind in debt. And so they capped the rates and fees to active duty military at 36%. We would say that would be right. There's something in us that kind of responds to that and says, well, that's good. We're providing these kinds of protections. And then we hear the story that, this cap was for, 36% for 90-day products. Well, what has the industry done? They've provided 91-day products. And as you hear that, you think, well, that's not right. And so there's this moral component that kind of enters into it. You deal with, how does that moral component, why is it that with something that seems to be so clear-cut morally, why have we not gotten legislation passed on that? And I think that's part of the discussion. I think that's why I'm here at the table.
Well, that's a perfect transition to our state representative, Mike Villarreal. He can tell us. Representative Villarreal was born and raised in San Antonio. He was the first in his family to finish college, receiving an economics degree at Texas A&M. Okay. And later earning a master's in public policy from Harvard's Kennedy School of Government. He served in the legislature since 2000, and he is chairman of the House Committee on Investments and Financial Services, which oversees for the House Payday and auto title.
Thank you. Forrest, thank you for bringing us together. This is a wonderful event to kind of get away from the Capitol and reflect on where we are at this moment on this issue. This is a tough issue. It's been great working with Ann and Bea and Stephen, who works with the the Baptist, representing them very well at the Capitol. And I've gotten to know Chad in this process, and was sharing that we need to change the way we do chaplain for the day and have him be like our doctor for the day that sticks around the whole day, that we can turn to for guidance. Because because right now the chaplains come and they say the morning prayer and then they leave. So we sure could use your help on a whole lot of issues, including this one. This is a tough issue because there are competing interests. How do we balance individual liberties with what I believe is our obligation to care for one another? And what does it mean to care for one another? Does it mean just passing a bill that limits access to capital? Most of the discussion has been focused on limiting this product. And we need to figure out how people who work, who have a struggle making ends meet, how they, in times of need, can have liquidity too. Our society has not figured this out. I think it's because our society is changing rapidly. The income gap between the haves and have-nots is growing rapidly and is so large. Our old ways of lending and providing banking accounts, savings accounts, checking accounts, these sorts of things that we used to take for granted, that so many families had ready access to. You know, the folks that are going to these payday lending retail shops aren't just, the desperately poor. There are a lot of working class folks that just have a hard time making ends meet. And they're raising a family and they have an education. Maybe they're a single mom. But we need to figure out how to help them. And I've sort of parachuted in on this topic. This is my first session as chair of financial services. My focus historically, since I got elected 13 years ago, has been on education and tax reform. And so I'm sort of, paddling and keeping my head above water. But I believe that there are some big challenges that the state of Texas is facing that are larger than payday. And I look forward to trying to steer my committee over the next few sessions to really grapple with these larger questions. How do we get our financial institutions, and how do we open up the door for our nonprofit institutions to get in the business of providing services to low-income folks, because their numbers are growing rapidly in the state of Texas. When I think about payday lending, I actually think about the foreclosure crisis that we experienced in 2008. That, for me, began with lenders giving out loans to families that should not have been given out. And they produced so many of these loans, they polluted the ecology of our financial system. And then, of course, Wall Street firms came in and started placing bets on those loans and made it even worse. Yes, it is true that, you can't ban human demands for, if somebody wants to do something, they're gonna go about figuring out how to do it, whether it's taking out a loan or any other kind of activity. We have a lot of activities that are illegal that have pretty vibrant markets. And so, how do we, in this case, come to appreciate that giving out these loans to individuals, payday loans, title loans, that really cannot be paid out by the customers is in the same way as the foreclosure loan, as the foreclosure crisis. It's polluting our communities. We have individuals, we have families that are strapped with debt that they cannot get out of. Their life is harmed, and I believe our larger community is harmed. And so I'm trying to figure out how to do something about it. Unlike my friend Chad here, who's a pastor, I'm a legislator.
Yes, you are.
Some days it'd be easier to just say, you know what, I'm drawing a hard line and I'm just holding true. But that's not my role. My role is to figure out how far we can go in getting the best deal for our fellow neighbors who need help. Pushing that line, getting all the way to the frontier, finding the limit of the impossibility without stepping over it. Because when you step over it, the bill dies. And we go home and nothing changes. The numbers, what were the figures you quoted? You said, is it 1,300 or 13,000 in 2004?
The number of storefronts?
Yeah.
1,300.
1,300 in 2004. In '05 was the first session I can recall where somebody attempted to regulate this industry. The bill died. More stores opened up. '07 there was another attempt. Bill died. More stores opened up. '09, repeat of history. 11, same thing happened again. Here we are in 13. 3,400 stores, new products, more loans, more businesses coming in, more lobbyists. We gotta break that trend. We have to pass a bill, I believe. And so we have to figure out the best we can accomplish, but we gotta get something done. And so I am trying to get something done. I filed the bill. We're gonna bring it up on Monday. We're going to make it better than I thought was possible. We just discovered the line of the impossibility is a little further out. We hadn't actually touched it yet. And so we're gonna be adding some amendments to our bill. And I'll rattle off a few. We're going to improve our bill, which originally limited the number of products to 4. Single payment, payday, single payment, title, multi-payment, payday, multi-payment, title. The bill originally limited the number of refinancings. It allowed for a payment plan, so when a consumer gets to the end of the rope, they could say, no more, give me 4 payments, no more interest, no more fees, I'm done. The original bill also limited how much could be lent out as a function of somebody's income. Disclosures had to include Spanish language upon request. In the end, that original bill we estimated would save consumers $132 million. We're gonna bring up a bill that does more. It is going to include the ability of customers to make partial payments on loans. It will add in penalties, fines, fees, if anybody violates the 4-product limit. Most important to me, because I don't know how these are gonna play out, right? This is sort of an experiment. We think this is gonna be an improvement. The 132 million original estimate is just an estimate. The most important thing to me has to be a preemption that needs to be renewed. So we will have a state law that has regulations that preempts cities, but that preemption goes away in 2 years. So that we can come back and see how our consumer protections played out. And if they did well, then we'll renew the preemption again. And if they did not work as well, well, the city ordinances are still in place and they force the industry to come back to the table. I think that will allow us to put in place what needs to be in place, and that is a statewide regulatory system. Because after all, it's wonderful that the cities have passed ordinances, but we know how those work with fireworks, with the consumption of alcohol in dry and wet zones. They're strong on paper, but they're meaningless. They're meaningless. Let me tell you, come to my neighborhood on the 4th of July or New Year's Eve. It is an explosion of fireworks. And so, while I am very appreciative of the city's passing ordinances, my own city did, it is the reason why we are here today. It's created havoc for the business, but it has not put them out or decreased the number of loans. It's mostly made the consumers have to drive up Fredericksburg Road to Balcones Heights to pick up their $1,000. So we need to do statewide regulation. And I am hopeful, even at this late date, that we can accomplish it this session.
Thanks. Okay, now I'm going to toss y'all some questions. So, leaving aside the political reality at the Capitol right now, what do y'all envision as the ideal solution? I mean, other states have capped fees, set limits on effectively the interest rate. Texas, the legislature doesn't seem to be too interested in that at this point in time. But if y'all could draft a perfect kind of plan for dealing with payday loans and this larger problem of people obviously needing credit, what would that look like? And I guess I'll let B take a whack at that.
Oh. I was gonna say, I don't know what would be ideal. I think a lot of people think that capping fees is the most sort of sure way to reduce costs for borrowers. I thought it was very interesting when limiting the number of rollovers was floated as an alternative to that, because I think, and then, I'm gonna punt, I guess, and say I don't know what totally the best alternative is, but I will say, because I'm here at the LBJ school, and probably a lot of you are too, what you want to start with is what the condition is that you want. So if the condition that you want is to limit the amount people pay and to limit the amount of trouble that they can get into, so to limit people from getting sucked into something that they can't ever get out of, I think it's better to start with those conditions and say, what are all the ways that you could get to those ideal conditions, rather than to start with, what's the one thing I wish I could have, what's the one policy I'd like.
Ann, do you want to weigh in?
Sure. I think that, this is not happening in a vacuum. It's not like Texas is the only state that has encountered this issue and this problem. And so it's really interesting to look at other states and to realize that Texas is really an outlier. The kinds of fees being charged in Texas are double, pretty much, what's being charged in Oklahoma, what's being charged in Florida, and these businesses exist. And so I think that idea that limiting charges is somehow incompatible with the existence of credit options, I think hasn't played out in other states. And so I would argue that looking at other states and taking those models and the things that we think are acceptable is really beneficial to us. I think that limiting the cost is really important, because all the borrowers I've spoken with, the cost is the core issue that gets them into trouble. it's the core issue. I mean, it's two things on this product. So there are two kinds of products. You have the single payment product that's due in 2 weeks or 1 month, and that's a problem, that structure. And then you have the cost. And what we're seeing in this market is this migration from these 2-week loans to these longer-term installment loans, which sounds like a good idea until you look at the price
Now
tag
tell
of
us
those loans.
explain the difference between your run-of-the-mill single payment payday loan and an installment one. I mean,
Sure.
what's the?
So the run-of-the-mill payday loan or auto title loan is a 2-week or 1-month loan that's due in full with all the fees in that short period of time. And so if you can't, so say you take out a $500 loan, in 2 weeks you owe $615. If you can't pay that off, you go another 2 weeks and you owe $615. You pay $115, you go another 2 weeks, you still owe $615, and it keeps going. And so that's one scenario, but the other scenario that we're seeing and is really growing in the market is these 6 and longer term installment loans that, 6-month and longer term installment loans that are carrying rates of 600% interest. And so the borrower will borrow $1,000 and owe $3,000 after 6 months. And a lot of the people that we've come across in those loans can't make those payments, and oftentimes hit a point 2-3 months into the process where they paid more than they borrowed. They're in financial crisis worse than when they walked into the loan, and they've hit a wall. They don't know what to do. And oftentimes it's those people who will end up at our charities, end up at the doors. And so one of the things that we need to keep in mind is that sometimes things on the face can look like they're real reform, but if you look at the trends in the market, and in this market we've seen that these businesses tend to find loopholes, and it's the pattern that we've seen, that where there's an opportunity to charge more, that's where the market will move. And so that gets me back to rates and how that's important, and I'm gonna tell you a little story because I think it really was an eye-opener to me. You know, we've been involved in a lot of negotiations around these bills, and a couple of days ago we were asked to come to a meeting where one of the largest auto title lenders in Texas was in attendance.
Can you tell us who it is?
I'd rather not name names.
Okay. Not to try.
And this individual was trying to sell us on the fact that allowing longer terms was better for consumers. That allowing them to charge 600% interest over 12 months was better for consumers than having these single payment payday loans. And he said, look, that 6 rollover limit, so the current proposal has on payday loans 6 rollover limits. So you pay the fees, the 25% fee 7 times, and then you would go supposedly into what they call an extended payment plan, where you would pay down the principal and have a way out of the loan. He said, look, they have that on the books in Nevada. Nobody ever gets into those extended payment plans, 20% at most. We just find a way to float people the extra days, that's the gap, and then they start the whole cycle again. And that's what he told us, and this is somebody in the business. And so I think that when we're looking at policies and at numbers that assert savings, we also have to look at the broader market, at the patterns of behavior in this market, because one of the worst things that we can do, I think, is pass into law something that purports to be reform, but in fact doesn't change anything for people on the ground. And I think that that's the balance that we're trying to struggle with. And we may come down on different sides of that, but any policy that moves ahead, you know, it has to be something that does provide meaningful changes. And there's nothing short of a rate cap that can really guarantee meaningful changes. I don't think that's the only solution. I think that what Bea was talking about, there can be limits, but we have to be very careful when we're looking at that limits to see how the market has responded to limits like that in other states, and to see how meaningful those really are. And when you have a proposal that includes loopholes around the limits, I think this industry's proven where they'll go. I think that we have a pretty good track record, and I'm concerned here in Texas. You know, I've seen a lot of consumer protection legislation, you know, pass in different areas over the year, like our home equity laws. We have some of the strongest home equity lending laws in the country. And what's most interesting to me is that that law was the strongest when it was passed. Every session since that home equity law has existed, it's been whittled away at and whittled away at. And I'm really concerned that if we go in with something that already has loopholes in it, you know, whatever the premise of the policy, that we're setting ourselves up to put something there that likely will be the status quo for some time to come.
Okay, so Senator Corona said something today that I thought, he sort of said before, but he was saying the heat of the moment and really got to the heart of one of the issues within the context of the legislature and the political reality. And he said, this industry, and I'm quoting him, needs some greater degree of regulation. And if we don't do it this time, this session, you won't be able to regulate this industry, speaking to the senators. You won't be able to regulate this industry 2 years from now. This industry will be so much wealthier, so much more politically powerful, that you won't be able to say no and you won't be able to draw the line. And Representative Villarreal, do you agree with that statement? It's almost a call to do something, even if it's far from what the advocates, what anyone may want.
Well, I've heard the senator make that statement before, and I don't know if I guess there's some truth to that, and initially that maybe there was some truth to that. I do believe, though, as Ann said, you know, sometimes if the proposal is so weak, you just got to say, no, I'm not going to put my name on that. I don't need to desperately pass a bill. I'd rather, you know, keep this weak city ordinances or ineffective, though strong on paper, in place. Even if there was some ounce of truth to that, I think the power dynamics have shifted incredibly over the last week with Steve and Amber Austin taking an interest in
Tell them who
this policy discussion. So Steve and Amber Mostyn. Steve is a trial attorney who's been very successful in the state and is actively engaged in campaigns. I think he donated, I think the number is around 4 million, maybe last cycle or the last 2 cycles, just he himself, in helping candidates run for office. And he and Amber have taken an interest in this issue and have actively engaged in negotiating for stronger provisions in the proposed legislation in the Senate and in the House. And that really has changed the dynamics. And so, you know, I was explaining to Stephen, first, you know, thanking him for caring enough to get involved. You know, on this issue, we've been negotiating with the industry, and tell me what you think. It feels like, you know, we're negotiating, but the playing field of negotiations is like this, right? and we've just sort of come to accept the unevenness of the negotiating table. It's slanted towards them. Everything rolls down towards them. Now that Stephen and Amber have gotten involved, it feels like the table is now level, and proposals that were floated earlier, like a database tracking these loans, now seems to be more acceptable, along with a number of other ideas. And so I think the advocates for consumer protections now have some wind in our sails, because now we have a combination of votes represented by the Baptists, all their churches and their members, the Catholics, AARP, all of our progressive churches throughout the state, and we have somebody who's willing to apply their financial resources to getting behind campaigns. And that combination is explosive. And the other side does not have a membership base. They only have money. They do not have a broad group of constituents to rally behind them. And so I actually think we're in a much stronger position, and I'm hoping that we can apply that today. But you know what, if we don't, well, the way to get better policy is to win some elections.
I know a lot of folks are working on alternatives to payday loans, because again, we get back to this issue of, and the industry uses this all the time as a talking point. By the way, we invited, I think, 3 different members of the payday loan industry, the head of the Consumer Service Association of Texas, and then 2 executives, and we weren't able to get anybody tonight. So I will try to fairly represent one of the arguments they make, which is that if you overregulate, you are meddling with a clear and obvious market demand, and you're actually going to harm the consumer, regardless of how great your intentions are. And so I know there are efforts to come up with alternatives to the traditional payday loan, and there are even some for-profit businesses, I think, that are out there that are trying to make this work. Does anybody want to pick up on that theme and talk about some of the things that have been tried?
Of course I will. We've got a group in San Antonio. I wasn't in on the initial meeting of it. It's called Together for the City. It's a group of, it started out as a group of downtown churches that were meeting with city and civic leaders to see how they could cooperate together on items of mutual interest and concern. And in one of the initial meetings, Diego Bernal, the city councilman in San Antonio, and the driving force behind the city ordinances that San Antonio passed with regard to this, he was at that meeting. In his own words, he hijacked that meeting to talk about the payday industry. And the group was rather diverse. They kind of got behind that and decided that was something that they wanted to kind of address themselves, and perhaps by creating some kind of alternative lending model that could compete in the marketplace. It was as they began to do that they found me and discovered that I had been involved in this in the last legislative session, so I got drawn into it. But there is a work underway to partner. It's basically taking a model out of Pittsburgh that has been operating for the past 5, almost 6 years now, where a group partnered with a local community credit union to provide, kind of be their front door, to provide small dollar loans at relatively low interest and fees. In fact, if you pay it back within the first 13 days, it's interest-free, is kind of their model. But with that, as you pay that back, it's kind of a membership thing that you not only pay back the loan, but some of the fees that you were paying to that group end up going into the credit union as a savings for the customer as well. So by the end of their time paying off the loan, they have not only paid off the loan, but they have a small savings set aside as well that they are then able to access. And so we're attempting to replicate that model. There's a few differences between Pennsylvania and the state of Texas in terms of some of the regulations there that have created some fun for us. But we're in discussion with several credit unions in the San Antonio area about partnerships and making that happen. There's another alternative that is gaining some traction in the San Antonio area. The San Antonio Area Foundation actually has kind of gotten behind this one, and it's an employer-based model. Basically, then it allows the employers to provide small dollar loans to their employees, so it kind of keeps the employees happy, keeps them stable, financially stable, and employable, and kind of helps for them as well. Probably the difference between the two different models. The Pittsburgh model, we are pairing that with some education as well. We discovered that a lot of the folks who fall into these kinds of traps just need basic financial education and some accountability. And once they have that, they're able to kind of begin to accumulate wealth for themselves. The employer-based model doesn't really include the education aspect of it. But those are two that I know of in San Antonio area. So.
Okay. We're running out of time, so I want to get to some questions from folks before we have to get out of here. Anybody want to?
Transitioning out of that, I'm curious. Is there unanimity of rates from one company to another? And that's kind of leading into the question, between a traditional bank loan and 600% interest, it seems to be that there would be a lot of room to move, or just within a general free market context, for somebody to come in and charge, say, 300% and try and compete in that market. What's keeping that from happening?
Is the market competitive? Or can we answer that question?
I mean, I think, I'll say first of all that I think there's not a lot of price competition. That's one of the things that's come up, is that rates are, the fees are, the interest rate is capped under state law, and the fees are pretty consistent from lender to lender. What they tend to compete on is other factors. So they may have kind of a vibe that attracts one kind of customer or another, or they may be located very near,
Location.
you know, so yeah, location, right? But, I mean, it's a good question about, you know, gosh, between a bank loan and 600%, if it really was 600% interest, it's a fee. So the fee and the way that you get to 600% interest is to become amortize what the fee would be, what the interest rate would be if that fee were being calculated as interest. I think, and I mean, I don't want to be an apologist for the industry. I mean, obviously I'm here as an advocating for payday lending reform. But I will say, I think that what a payday lender might say is, the fee includes some risk. So the reason the fee is high is that some number of people, probably a lot of them, are gonna default eventually. They are not ultimately gonna pay off their loan. And so, you know, the argument that a lender probably would make would be that that fee is not, it's not pegged to an interest rate, it's pegged to my risk every time they come in, that might be the last time I see them and I may never get that principal. So that I think is why you probably wouldn't see a slide between
There's not as
bank
much
loan,
yeah. Undersell as
yeah,
as
I think what there are though are alternatives, like actual alternatives, where they charge an interest rate that's more like, what is like 20%, right? Or it's 15%, they would like to go to 20. So there are alternative structures. They have a hard time competing, I think, with the extreme convenience of traditional payday lenders.
Can I interject as a data point? Just, you asked about like percentage. If you Google non-for-profit payday lending, there's an example out there from Wisconsin. Name of the company was Good Money. They hit 252%, and this is as a non-for-profit, and it was because of the large number of just straight outright bad loans. So they still ended up, that was as good as they could get, was 252. Their goal was 18.9.
Wisconsin, it's a non-profit.
One of the reasons that you don't get as much price competition as you might ordinarily expect, you get a lot of price competition in the mortgage market, for example. Everybody got tables in the newspaper, you can figure out who's going to get you a slightly better deal. And an eighth of a percent of something people are actually going to act on. In this market, nobody gets a payday loan believing they're ever going to roll it over. They all get a payday loan thinking at the end of 2 weeks, everything's going to be fine, I'm going to get my check, I'm going to be rolling into, I'll pay this thing off, and I'll never see these guys again. And the difference of $50 or $25 is fairly trivial relative to convenience if it's a one-time only transaction. It's only when it goes over and over and over again that it starts to add up to be real money.
Thank you. What about looking at other states? What are is there an apples to apples comparison there in terms of rates? Texas versus other states in terms of rate, because we have a lot more stores here, so you would think presumably.
Outside of Texas, the rates are generally significantly lower. There are 15 states that have 36% or around their rate caps. And in those states, there were some surveys done recently, and they found in some of those rate caps are relatively new, and they surveyed people who had used payday loans before, and only 5% of the individuals who had used payday loans said that they were going to seek them elsewhere, either online or other areas, that the vast majority of people were happy that option wasn't available to them. They were going to family and friends, they were using pawn shops, they were using other means of meeting their needs or negotiating with their, then there's a segment of states, about 17, that have rate caps of $10 to $15 on 100. And so that's more or less half of what's being charged in Texas, and in those states the businesses are operating and functioning. So and then another industry, and actually you'll see a lot of op-eds by these businesses, which is consumer finance companies. They operate actually in that space in between the bank loans and the 600%. And I've seen a number of complaints from individuals who've gotten caught. And there is one thing I wanted to correct beyond, which is that a lot of these auto title loans are secured loans, and lots of people lose their cars you know, there are totally secured loans, and lots of people lose their cars to those loans, and still they're at 300% interest. But they're saying, you know, everybody's looking for the alternative. We're the alternative. And I've seen lots of complaints where people say, well, I went to a finance company and they only charged me, you know, 60 or 80%. How is this legal that I went to the payday lender and they charged me this outrageous rate? I mean, I think that a lot of times people walk into the payday lender and it's like Councilman Spelman said, they say, oh, it's only 15%, because it's 15% for 2 weeks. And so people don't necessarily think about it as the long-term impact of the loan. And so a lot of times if people maybe thought about it a little differently in the long-term impact, they might go to another option or seek out another option. And the other point I was, okay.
Because we only have a few minutes
Sure.
left. Let's take another question.
I'm curious about the opposition to the bill in the legislature. Are the people who are opposed to it, is it a civil liberties issue? Is it they don't think it's the right bill that's being proposed? Is it money that was mentioned?
Are you talking about legislators or?
Yeah, legislators.
Okay.
So there's always two reasons. There's a good reason, and then there's the real reason. So the good reasons that are given are usually grounded in ideals about free markets and civil, liberties and property rights and being able to do business and respecting, adults who enter into mutually agreed upon contracts and all that kind of language and stuff. And that's why they don't like the idea of the state government setting conditions on what is appropriate. This industry has also given a lot of money to campaigns, and they have lobbyists that are walking every corner of the Capitol, every hallway, surrounding members, preaching their side of the story, and getting members to sort of see things in their framework. Ultimately, we're going to see where people stand when the bill hits the floor, if it ever gets that far. And I think with all the legwork that these different consumer advocates have accomplished, I think folks are going to have a difficult time making those kind of free market arguments. But those are the reasons why the bill may die. The bill that I'm going to bring to committee is going to be a bill that I can be proud of, but I may not have the votes to get it out of committee.
Just as another fact, there was a report that came out recently, I'll get to your question, that the dollar figure for the amount of political contributions made by this industry is about $4 million between, I believe it was 2009 and 2012. Oh, man.
Yeah.
No.
Oh,
I'll take yours next.
I ever since Representative Villarreal told the story about Steve Mostyn, I've been kind of stuck on that moment in the conversation, and I know this is not really supposed to be the focus of this particular panel, but I just have to say I think it's a very depressing state of affairs, right? When the only way we can move on a progressive issue that the vast majority of people feel is the morally right way to go is by having somebody that has just as much money as the other guys to pay off the legislators to vote because they're going to support them in the next campaign. I'm sorry, I'm just disturbed by that.
I think it's important to have that perspective, because those of us who spend a lot of time in the Capitol can become inured to that.
Yeah.
So it's not so much paying off legislators.
I don't mean paying, you know what I mean. I mean supporting their campaign.
So legislators want to be reelected. And to do that, we have to run for office. And if we're opposed, you have to raise money to get your message out, to characterize yourself. Advertising isn't free. TV, radio, print, all that costs money. Your opponent is going to raise funds to characterize themselves and you. And so it unfortunately, in this state where there are no limits on campaign contributions and free access to the airwaves does not exist, it costs to run for office. And so I work in a field that lets me attempt to reshape the world as I'd like it to be, but I have to deal with where we are today, and this is where we are today. And so I welcome Austin's presence in this debate because it strengthens our hand in order to pass progressive legislation. It is what it is.
It does seem like it's a money versus morality kind of thing, doesn't it? I mean,
But there's another way, I think, to look at that, and it's interesting that Ann is the one who asked that question, because I was gonna point at her earlier when the question was, can a bill pass next session? If we don't pass it, will they be so strong next session? And what I would say is, only if the public lets them be, right? I mean, only if the public doesn't give legislators the support they need to pass legislation. And Ann is the director of the program that tells us that we have low civic participation, we have hard time getting people involved in the policy debate, and that's part of the trick for legislators, is that this may be a very important issue to a lot of people, but if they don't vote, then the only thing that votes is the money. And you said, so campaign finance, then that's a problem too. We got a lot of problems, the healthcare, the campaign finance, the payday lending. It's like one of those games where you can only move one square at a time, but you want to go ahead and keep moving them, right? A little bit, a little bit, a little bit. You'll get it there.
Yeah. Okay. Sir?
It's kind of related. I just finished reading David K. Johnson's book about the IRS, which is actually 10 years ago, but he said the tax preparation agencies like H&R Block have basically the same thing. They get people and then they charge them all kinds of fees, which sounds exactly like payday loans. Is that still the case?
Yes.
Okay, that was quick. Anybody want to elaborate?
No?
Pete, you had said that your organization looks at sort of the fiscal impact of legislation. I'm trying to understand what it would cost, the taxpayers of Texas to pass legislation, and then also who would benefit or lose out if certain types of legislation were passed, putting limits on, because you talked about limits.
Right, and so the fiscal implications for a bill like this are not directly to the state, so it's not like it costs, it potentially costs the state a little tiny bit of money to enforce regulations, right, but that's not the main implication. The implication is if you pass legislation, if what we're concerned about is that borrowers are paying too much, then the way you know it's a successful bill is if they pay less. Right?
That's the fiscal
you
analysis.
can do all that other stuff, you can do a lot of
Financial.
other kinds of things that are good for borrowers, but if the central concern is they're paying too much, then win is if they pay less.
And just briefly, what is the figure that's been calculated for the legislation?
The
question?
figure that's calculated for the legislation is that the legislation that is in the Senate right now on hold would save borrowers $132 million a year conservatively, and that is 20% of the fees that they're paying right now. So it's not insignificant, the amount of savings that they would get.
Any other questions? Piper.
I'm curious about who's taking out these loans. I mean, you mentioned people coming in, you mentioned regulations in Spanish, and you mentioned working class families, but what are the statistics on who's going in and getting these loans?
Good question.
Yeah.
Well, I can tell you who's getting them sitting across my desk. The one thing is that it's not the poorest of the poor. It is the working poor. That all of them have to have some kind of stream of income coming in to qualify for the loan. So we're not talking about the homeless folks. We're talking about a step above that. That most of them are employed and lower income as far as that goes. I'm not sure about the statistics on, ethnic breakdowns and those kinds of things, or even gender breakdowns. But for me, it's run the board. I mean, we've had, large families, we've had single moms, we've had single individuals, we've had white, we've had Hispanic, we've had black. So, I mean, there doesn't seem to be at least for me, a real pattern on that. But I'm a very small slice of the larger pie too. So.
You want to?
I mean, just the statistics, there are some statistical analyses that have been done from national surveys as well as local surveys, and on payday loan tends to be dominant women, majority women, lots of single mothers disproportionately represented in that population. The income range we're seeing is 20 to 40,000 seems to capture the vast majority of this market. Some interesting statistics that people are surprised to hear, which is about 20% are seniors, or people in the 50 and up, and we've heard a lot of stories of people on Social Security and fixed income getting caught, but that the big demographic is $20 to $40,000 a year in income, and tends to be women, and in that kind of middle, starting to middle working age range, when people tend to have families, like 20 to also, the 20 to 40 age range, where people are working and will likely have other obligations. There are different statistics on payday lending. It tends to be largely Hispanic and African American, but not everybody. I mean, there's more statistically in those communities. In auto title lending, it's a little more male focused and a little more more diversity across the different ethnicities.
I believe AARP also came out, did they not, with their constituency tends to tend more toward the auto title loans. They speculated that was just the secured aspect of it, that they kind of related to that a little bit better. So they've gone more to the auto title than to the payday.
And of course, to get a payday loan, you have to have a paycheck. You got a job. These are working people by definition. Last question, Brad.
You talked a little bit about the risk that these companies are absorbing with these high fees and rates. Do we know anything about the profit margins in the industry?
Huge.
Do we know anything more specifically than that?
Well, like First Cash Pawn, I think just issued their, had their quarterly stock report. They're up 25% for the year. I think they had 15% profits, but the value of their stock is up 25% for the year. I think at the end of the year, Easy Core issued their stocks, and they had significant profits.
So they're managing the risk pretty healthily. Thanks.
All right. Thank you to our panelists very much for being here, and thank you.